about chapter 11, and chapter 11 talks about transaction exposure. Basically here, what we are saying is that if you are a company, you're multinational, you have to make a payment, so that could be an accounts payable, or you are receiving a payment as an accounts receivable. How do you manage that? Okay. And here, we're going to talk about 3 ways you can manage that. So the first one, that is referred to as a money market hedge. So that is perhaps the simplest way to make a transaction. Okay. The second one is a forward market hedge or a futures hedge. And the third one is an options market hedge. So these are the 3 main things we're going to talk about if you have to make a transaction. So basically here, we're talking about either making a payment or we're talking about receiving a payment. Now, if you are a multinational, if you want to be in business for a long time, you might have a longer term strategy. So there, if you want to use a financial security, so one way to do a longer term strategy is to enter into what is referred to as a currency swap. And the third way is you basically want to hedge your cash flows by doing another transaction. One example would be, let's say, if you look at Toyota, they do a lot of business in the US, which means that maybe around 40% of their income revenues comes from the US. So what they do is to hedge their against the cash flows. What they do is they also set up some of their operations in the US. So that way, some of the money they make here, they can also use it for what they call the goods sold or for their manufacturing. Again, that is a longer term strategy. But basically here, we talk about a single transaction and how we can hedge that single transaction. Okay? So I think I'd rather talk about the money market hedge first, and that is the simplest one, and then talk about the forward hedge, and finally the options hedge. Okay? So what is a money market hedge? To hedge a foreign currency payable, buy the present value of the foreign currency today and sit on it and invest that amount at the risk-free rate. At maturity, your investment will have grown enough to cover your foreign currency payable. So basically here, what we are saying is that suppose you have to make a payment, let's say €1 million in 1 year. Okay? You don't want to worry about foreign currency risk. What you could do is you could buy the euro today. So rather than wait a year and worry about exchange rates, right now the euro is not very strong against the US dollar. So you don't want to wait. What you want to do is you want to buy the euro today. And the question is that how much euros do you need? Basically here, what we are saying is that if you have to make a payment of 1 million, you don't need all the 1 million euros today. What you need today is the present value of the 1 million. And basically here, what we are saying is that you borrow the present value of the 1 million and keep it in euros, in euro. And at that time, 1 year from today, you will have the 1 million that you need to make the payment. So that's basically here in the case of the money market hedge. So let's look at this example. A US-based importer of Italian bicycles in 1 year owes 100,000 euros to an Italian supplier. The spot exchange rate is $150 equals €1, and the 1 year interest rate in Italy is 4%. So what we see here is that you have to make a payment of 100,000 euros in 1 year. And how can we avoid the exchange rate risk? In the case of the money market hedge, what we are doing is that we are borrowing or we are buying the present value of the payment that is owed. So here, 100,000 euros is what you have to pay, and you can find out the present value of that. So the present value of that is going to be $96,150.85. So in this case, what you do is that you buy 96,153.85 euros at the current exchange rate. And what is the current exchange rate? It says that the current exchange rate is 1.5. So to figure that out, how much do we need? That is going to be the 96,153 multiplied by 1.5, that gives you the $144,230.77. So that is how much you need today. Now, when you look at the question can ask you in a couple of ways. So what is the present value dollar cost? So what we have here is the present value dollar cost. Now, the question can also ask you what is the future value dollar cost. So the future value dollar cost, basically what we are assuming is that perhaps we are borrowing the money to buy the euros. So there we also have to pay interest on that, which means that to this number you want to multiply it by 1 plus the interest rate in the US. So in this case they will talk about that, but we could add maybe one more sentence. So suppose the 1 year US rate is 3% that is given to you, and you want to find out the future value dollar cost. How do we do that? All that we're going to do here is that we found the present value, we want to multiply it by 1.03. So what is future value dollar cost? So that is going to be the amount you have to pay. We already found that out. That is 144,230.77 multiplied by 1.03. So that gives you the future value dollar cost. So basically here, what we are assuming is that as a company, either you are borrowing the $144,230 at an interest rate of 3%. That is one way to think about that. Or a second way to think about that is, basically we are assuming that you already have the money, but you are losing that interest. Because here, you could have kept it in the US, you could have the 3% interest, but by buying the euros and putting your money in Europe, you are giving up something, and that is the US interest rate. So these are the two ways you can think about that. But in terms of math, when you talk about the future value dollar cost, all that we are doing here is that once you find the present value, you want to multiply it by 1 plus the US interest rate. So these are the steps you see in the case of the money market hedge. So this basically talks about the steps. So what are the steps here? The first is that you want to find out the present value of the payment that you owe. Okay? So the present value in foreign currency. Looks, I think they make it more complicated than it should be. So in this case, the amount you owe is 100,000 euros. So what we do here is that we want to do a step 1, find present value in foreign currency of payment owed. And that is like the first step. So here, the payment you owe is 100,000 euros. We want to divide that by 1 plus the interest rate in euros. So that is like the first step we have. We want to figure out the present value. Step 2, find cost in US dollars. So for us, that was $96,153.85. So step 2, what we are saying is that we are buying the euros at today's exchange rate. And today's exchange rate is 1.5. So that's what we have here. So in this case, that would be $96,153.85 multiplied by 1.5, and that gives us the 144,230 point. And the last step is, if your asked is future value, so dollar cost, that would be 144,230.77 times 1 plus IUS. Okay. So that gives us the future value dollar cost. Now, as far as exam 1 is concerned, so you can bring a 1-page formula sheet. So you can write down all the steps. As long as you don't have any numbers, that's fine. Okay? So please make sure you don't have any numerical examples, but you are going to write down all the steps you need. Okay? So how do you do money market hedge? This basically tells you how to do that. Okay? Now, we could do the same example. What happens if, rather than have 100,000 euros payable, suppose you have 100,000 euros received. Now, if you do that, the numbers don't change, but the steps will change. Okay? So, in this case, if you are a US company receiving 100,000 euros, and what would you do? Basically, what you can do is you can borrow the present value of the payment that you are receiving. So there, the number would be the same. So you could borrow the present value. So if you can borrow in euros, you could borrow the present value of the payment that you are going to receive. Okay? So that would be the $96,153.85. And once you have that, you can convert it into US dollars. So that gives you 144,230.70. Okay. And what's going to happen is that when you receive the 100,000 euros, you're going to pay out the loan. So that is, if it's accounts receivable that rather than accounts payable. I just showed you the example, but chances are, if you get a question, that's going to be more based upon an accounts payable. More complicated, but these are 8 steps. So calculate the present value, or the US dollar value receivable spot rate, exchange and invest, and at maturity, your pound sterling investment will pay your receivable. So let's go back and let's talk about the forward market hedge. So as far as the forward market hedge is concerned, what do you do in the markets? So basically here, what you're saying is that if you are a multinational, if you are going to owe foreign currency in the future, agree to buy a foreign currency now by entering into a long position in a forward contract. So basically here, what we are saying is that if it's an accounts payable, what do? So you have to make a payment, and to make the payment, you will buy a forward contract, or you will buy the required number of futures contract. And on the other hand, if you are going to receive foreign currency in the future, agree to sell the foreign currency now by entering into a short position in a forward contract. So if it's an accounts receivable, you want to have a short position in the forward market. So let's look at this example. You are a US importer of Italian shoes and have just ordered the next year's inventory. Payment of 100 million is due in 1 year. So that's what we see here. Now, we can look at a couple of examples. What happens if you are unhedged, and we can also talk about what happens if you are hedged. So to make life easy, let's assume that the exchange rate today is 150. So the exchange rate today is 150. So let's say it's 150. You have to make this payment of 100 million, what is that, euros, yeah? So you have to make this payment of 100 million euros, and let's assume that the exchange rate is 1.5, okay? So at 1.5, how much do we have to pay? In US dollars, what's the cost?
150.
That's going to be 150, isn't it? So this is what you see, and all said and done, this basically tells you what happens when you are unhedged. So if you are unhedged, let's say the exchange rate goes to 2, you're going to pay 200 million. If it goes to 170, you pay 170 million. On the other hand, if it goes to 1.2, you pay 120. Okay? If it goes to 1, you pay 100 million, and so on. Okay? So basically here, this tells you how much you have to pay if you are unhedged. And essentially, what we see here is that if the exchange rate goes up, it's going to cost you more. So if it goes up by 10 cents, it's going to cost you 10 million. Yeah. On the other hand, if it goes down to 1, that's going to save you a lot of money. Then you're going to save $50 million. So that is what you see if you are unhedged. Okay? So you can save a lot of money if the exchange rate goes down. At the same time, you have a lot of exposure if it goes up. Now, let's look at the case where you are buying a forward contract, and let's say the exchange rate is 1.55. So if you buy a forward contract, so let's say you go to a bank and you buy a forward contract where you have the right to buy the British pound at 155. Okay? So what's going to be a cost? Does it change? And how does it look like? What do you think? So if you buy a contract, let's say with a strike price of 155, what do you think is going to happen? So what we said in the case of the futures contract or in the case of the forwards contract was you have the right, but you have the obligation. So the answer for this is very easy. All that you're going to do is take the 100 multiplied by 1.55. Okay? So regardless of the exchange rate, you always pay $155 million. Okay? So that is a nice part if you buy the forward contract. So as far as solving the problem in class, it's not very hard. It's always 155. So this is going to be 155. And how do we get that? That is the 100 million multiplied by 1.55, which gives you $155 million. Okay? So in this case, what we see here is that when the exchange rate is about 155, okay? So this is 155. Okay? At this point, you look very smart. Okay? And the reason being that you are paying less than your competitors. Okay? Your competitors might be paying 160 million or 170 million. In this case, you are only paying 155 million. On the other hand, if the exchange rate is below 1.55, so let's say it's 1.5 or 1.4, you don't look all that smart because your competitors might be paying considerably less than you. So that is the basic difference when you compare the futures contract with the options contract. And basically what we see here is that in the case of the futures contract, you have the right, but you also have the obligation. So in terms of answer, it's straightforward. All that you're going to do is multiply the amount owed by the strike price of the futures contract. So it's the same 155 million regardless of the exchange rates. I don't know, they have a lot of numbers. Anybody looks more confusing than it should be, but this is pretty much what we have when you talk about the too many graphs and so on. So what I want to do now is, we want to talk about the options market hedge. So we talked about the money market hedge, we talked about the forward hedge, and the last thing we want to talk about is, we want to talk about the options market hedge. So options, as we talked before, provide a flexible hedge against the downside while preserving the upside potential. So what we said here was that you have more flexibility, so if the exchange rate goes up, you want to exercise, you want to buy the foreign currency and at a cheaper price. On the other hand, if it goes down, you always have the flexibility of walking away. Okay? So to hedge a foreign currency payable, buy calls on the currency. So just like buying a futures contract, here, if you have to make a payment, you want to buy the call options. And if the currency appreciates, your call option lets you buy the currency at its strike price. To hedge a foreign currency receivable, buy puts on the currency. So if you are receiving money from abroad, what we said was you would sell a forward contract. In the case of the options market, you want to buy a put option. Okay? And if the currency depreciates, your put option lets you sell the currency for the strike price. So here, we want to talk about the same example. Okay? Suppose rather than buy a call option, okay? In this case, we are talking about an importer who owes 100 million euros, okay? And in this case, he's buying a call option. And by the call option, when he buys it, the price he pays is 5 cents. Okay? So the call premium here is 5 cents. So we want to talk about what happens. Can you? Okay, so let's look at the options market. So what we are assuming here is that he is buying a call option with a strike price of 150 and the call premium is 5 cents. Okay? So that's what we see here. He pays 0.05 per euro for the call, and he has to make a payment of 100 million euros. Okay? Now, if we just look at the payoff, so for the call, what we see here is pretty much like what we talked about before. So you pay 0.05, and after that, 150, 155. So this is what happens as far as the payoff on a per unit basis is. Now, what we are looking for more is, in this case, in this question, what we really want to figure out is that what is going to be your overall cost. Okay? How much do you end up paying in practice? And it depends upon the strike price. It also depends upon the exchange rate. So chances are, if you get a question in the exam, rather than what we talked about in chapter 5, chances are it's going to be related more to chapter 10. So basically there, if you are a multinational, what is going to be the overall cost of making a payment? Okay? Rather than the profit and loss that you see here. So you have to look at two things. One is you want to see what happens in the spot market, and the second is you also want to see what happens in the options market. So what is the best way to do that? So the best way to do that is we can assume that in this case the importer buys a foreign currency is time t equals 0, and this is time t equals 1. Okay, so this is the spot price here, this is the forward price, and this is the spot price at time t equals 1, and this is the forward price at time t equals 1. Okay, so these are the prices. So to figure out what is the actual cost, what we can do is, we can do it in two parts. So for this company, what they might do is, they go to the market and buy the foreign currency. Okay, so we are ignoring the futures contract. So what they do is, whatever the market price is, they buy it at that price. So here, this is going to be the 100 million multiplied by the spot price at the end. So when they have to make the payment, whatever is the spot price, they basically are going to pay that and get the foreign currency. But they also do something else, and in this case, they also bought the call option. Okay? So what we can do is, based upon what we saw earlier, we can find out the profit or the loss in the options market. So the profit or loss in the options market pretty much is based upon what we studied in chapter 5. So that is going to be way, we can figure out the profit or loss to this company. So basically here, what they're going to do is that they go to the foreign exchange market and buy the foreign currency at whatever the market price is. So that would be the spot exchange rate at the end. At the same time, in the options market, they can basically close out their position, and this tells you what happens in the options market. So to figure out their overall cost, what we're going to do is we're going to add these two together, or in this case, sorry, not add. The first number, which is the 100 million multiplied by the spot price minus the profit you make in the options market. So that way you get the answer. Okay, so we can, to do this, I think we can look at two examples. And the two examples we want to look for is, let's say at the end, the market price or the market exchange rate is 1.45. So if the market exchange rate is 1.45, what do you think will happen here? So before we start, maybe we can calculate how much they spend for the option. And what the question says here is that the cost of the option is going to be the 100 million multiplied by 5 by 100. Okay? So they pay $5 million for the call option. So that basically, I think that numbers there gave you that. For the previous slide, it showed you that. So it says here, he pays 5 cents per euro for the call. So for 100 million, he's going to spend 5 million US dollars. So that's what we have. So at 145, what happens here? So at 145, if you look at this number, the importer buys the foreign currency in the spot market. So here, the cost is going to be 100 times 1.45, which gives him 145 million. Okay. You can put the whole thing. So that is the amount he pays for the currency. Now what happens in the futures market at an exchange rate of 1.45. Will he exercise or not? What is it? He will not exercise it. The reason why he does not exercise is because if he exercises, he has to pay 150. Here, he only pays 145. Okay, so that's the reason why he will not exercise. And so, profit in options market, that is a loss of 5 million. So what is going to be the overall cost? The overall cost here is going to be how much? 150 million, exactly. Because he paid 145 million for the foreign currency. He also spent 5 million upfront for the options. Okay? So overall, you want to add them together to figure out the number. Okay? So that gives you 150 million. That is going to be his cost. Is it okay? Talk about the next case, 180, is it okay? Now, we want to look at the case where the exchange rate is 180. So if the exchange rate is 180, so rather than 145, it's 180. Okay? So we can again do the same number. So what happens in the options market, sorry, the spot market is going to buy at 180. Okay? So that is going to be a cost of 180 million. Okay? So 180 million is his cost when he goes to the market and buys the foreign currency. But what happens in the options market? So in the options market, the answer is going to be 180, okay, minus 150 minus 0.05. That's what we get here. So on a per euro basis, he makes a profit of 25 cents. Okay. Now overall, it's 400 million. So his profit is going to be 25 million. Okay? So in the options market, that is going to be 100 times 0.25. That is going to be 25 million US dollars. So overall, his cost is going to be 155 million. So this basically tells you his cost at an exchange rate of 180. So what we see here is that up to an exchange rate of 150, the option will not be exercised. So his cost is going to be the spot price, okay? Whatever the spot price is, minus the premium he paid for the option. So he's going to lose the money he spent for the option. So in this case, that's $5 million. Okay? On the other hand, when it goes above 150, it tells you that he will exercise the call. And in that case, his cost is going to be 155 million. So the most he would spend is 155. Okay? And whenever the exchange rate is above 150, that's going to be his cost. It's always 155. On the other hand, if it's below, then his cost is going to be whatever the spot exchange rate is multiplied by the total size. Okay? And you also want to add what he spent for the option, because he's going to lose the money he paid for the option. So that is pretty much the bottom line in this case. Now, if you want to look at the other case, suppose you are hedging exports with put options, what happens in the options market? Here, if you are an exporter, the exporter sells the foreign currency in the spot market, and you can also look at the profit or loss in the options market. So the actual cost is going to be pretty much the same thing, whatever he gets in the spot market, and he also receives the profit in the futures market. Okay, so that is the basic difference here. What we are talking about is that actual amount received. So things change a little bit, and the reason why things change a little bit is because you want to add the profit he makes in the futures, in the options market, because he's also going to get that money. So let's look at this example where K is $2 and the strike price is the put premium is 0.05. So these are the numbers. And let's assume that here what he's receiving is